All right, so now that we have discussed simple capital structure and complex capital structure, we also discussed why these three securities are called potentially dilutive securities, and the addition of any single of this security from these three would make the simple capital structure complex. And as we said, these are called potentially dilutive because if their form changes, if they get converted, for example, into common shares, then that might potentially bring the EPS down, and that is referred to as potentially dilutive securities. And the principle is, if they are found to be dilutive, then the accountants should not only report basic earnings per share on the face of the income statement, but also dilutive earnings per share as well. So now you'll do an exercise to try and determine whether these securities would be dilutive or not. So as I said before, here's one key point that you need to understand. Let's talk about convertible preferred share first. So let's look at convertible preferred shares. So these are preferred shares in which the investor has the option to convert into common shares. So it's an option, it's not an obligation. And before that, you need to recall what we have discussed before. We said you have EBIT, we subtract interest from expense from this, we get earnings before tax, we subtract tax expense from this, and that gives us net income. Then preferred dividend gets paid first. The leftover profit is called EBCS. Now, in order to decide whether a security is dilutive or not, we will do an exercise on paper, which would be what would be the EPS if it's not converted, and what would be the EPS if it's converted. So basically, we are doing what-if analysis. So for the purpose of calculating the basic EPS, what we are going to make an assumption is that it will not be converted. So we assume that preferred stock would not be converted. And if it would not be converted, that means it remains as preferred shares. Hence, preferred dividend would continue to be paid. So we'll continue to pay preferred. Therefore, if you assume that preferred stock would not be converted, since it's like a normal preferred stock, the basic EPS calculated should be net income minus preferred dividend, which gives you EBCS, earnings belonging to common shareholders, divided by weighted average common shares. The number of shares would not change since we are assuming that it would not actually be converted. Okay, let's look at what if it's converted, and for that reason we want to calculate dilutive EPS. We want to see whether it's dilutive or not. So we assume that preferred shares are converted to common. And if they are converted to common, that means there would be no more preferred dividend. So we would not have to pay preferred dividend anymore. So no more preferred dividend. We would not be paying any preferred dividend. Now, I'd like to just go back and write here. We could write it this way, or we could write it as EBCS divided by weighted average common shares, right? You would end up with the same answer. Okay, so here's what I want you to basically notice here. You have to see what is your starting point. What are you given in the question here? If you are given net income, and if the preferred shares are convertible, and we make an assumption that they have been converted, hence we don't have to pay preferred dividend anymore, then the EPS, dilutive EPS in that case would be net income minus 0 preferred dividend. There is no more preferred dividend because all the convertible preferred shares have actually been converted. So since they have been converted, we don't have to pay preferred dividend anymore. Hence, we are not going to subtract any dividend or preferred dividend on convertible preferred shares since they have already been converted. Divided by, we can call this old weighted average common shares. So whatever the shares were there before the conversion, plus you will have to also add new shares. because after converting the preferred shares into common, you'll have new common shares. So this is how the formula would actually become. So if you understand this, you should be able to produce the earnings per share, and they'll give you the conversion ratio. So you will get to know how many new common shares would the investors get upon conversion of preferred shares. All right, what if you're given EBCS? What if you're given in the question earnings belonging to common shareholders? Now the thing is, if you're given earnings belonging to common shareholders, if you pay attention, that means the preferred dividend has already been subtracted from the number that has been given to you, while we do not pay preferred dividend anymore. So what we are going to do is, to cancel the impact of preferred dividend, we will add back. So previously it was subtracted. When we add back, it sort of cancels. So we have removed the effect of preferred dividend by adding back. Make sure you understand this again. We're not subtracting any preferred dividend here. We're adding back preferred dividend here to cancel the effect of preferred dividend in the profit that has actually been given to us. While the denominator would actually stay the same. You'll have all weighted average common shares, plus you'll have new common shares as well. So having understood this, let's look at an example now to try and answer this. So it says, for the year ended 31st December 2018, Bright Warm Utility Company had net income of 1.75 million. The company had an average of 500,000 shares of common stock outstanding, 20,000 shares of convertible preferred, and no other potentially dilutive securities. Each share of preferred pays a dividend of $10 per share. So 20,000 times 10, that means the preferred dividend is 200,000. And each is convertible into 5 shares of the company's common shares. So each one preferred share is converted into 5. That means 20,000 times 5. The new shares would simply be 20,000 times 5 is equal to 100,000 new common shares. So this should be an obvious, simple conversion ratio is given to us. Calculate the company's basic and diluted EPS. So for basic, we made the assumption that we are not going to convert. So we will continue to pay the preferred dividend. So the basic EPS was, since we are given the net income here, we will start with net income, we will subtract preferred dividend, and we'll divide this by weighted average common shares. So let's plug in the numbers here. This is 1.75 million minus 200,000, that's your preferred dividend, divided by the weighted average common shares are given to us as 500,000, and the answer we get is 3.10. So that's the basic earnings per share. All right, let's look at the other side now. What we want to see, whether we want to do what if analysis to see whether it's dilutive or not. So let's say dilutive EPS. Keep in mind, it could be anti-dilutive as well. If the EPS goes up, then it will be anti-dilutive. And in that case, only the basic EPS would be reported in the financial statements. So for dilutive EPS, we make an assumption that on paper, we are converting the preferred shares. Hence, there is no more preferred shares, and they have been converted into common shares, and there will be no more dividend. So given that we are given the net income, so we will start with net income, and since there is no more preferred dividend on the convertible preferred stocks, therefore we will subtract 0, no more preferred dividend, divided by the old weighted average common shares plus new common shares. All right, net income is given to us as 1.75 million minus 0, no more preferred dividend, divided by the old shares were 500,000 plus 100,000. Those are the new shares which we have already found. And again, the ratio is quite simple. So that's how you will get it. One preferred share is giving you 5. So 20,000 will give you 20,000 times 5. And the answer we get is 2.92. As you can see, it is dilutive, meaning on paper, if we convert the convertible preferred stock, then it is actually dilutive. And on the face of the income statement, both basic earnings per share and dilutive earnings per share would actually be reported. All right, I would just like to add something here. it may happen that they might tell us that the company has issued two types of preferred shares. So the company might have issued convertible preferred shares and just plain preferred shares, meaning normal preferred shares. In that case, when we do dilutive EPS exercise, we would assume only this one gets converted, so we don't have preferred dividend on this, no more preferred dividend, because this one got converted. But the plain preferred shares, or the preferred shares without conversion option, will not be converted, so we will continue to pay preferred dividend on this. So your formula would pretty much become something like this. You would say net income minus 0 preferred dividend on the convertible preferred shares, but you will continue to subtract the preferred dividend on the simple or the plain preferred shares because these are not converted. And we would only make the assumption that these ones get converted, not these ones. So you need to be careful if in case they combine this and they tell you that a company has issued both convertible preferred shares and also normal preferred shares. Make sure you know that we would only make the preferred dividend on convertible preferred shares as 0, while on the plain ones, we will continue to subtract when calculating the dilutive EPS. So now that we have understood how to check whether convertible preferred stock is dilutive or not, we're going to use the same rationale for the convertible bond. Let's talk about convertible bond now. All right, so before we try to understand how to find a dilutive EPS for a convertible bond, let's understand the concept that interest is tax deductible. In other words, if a company borrows money and is paying interest, then it would actually be paying lower taxes. So here is how we could look at this. So we're talking about interest tax deductibility. Let's say there are two companies. There is company A and there is company B. And let's assume that the tax rate is 30%. Let's say company A has profit before tax or earnings before tax of 100,000. Or sorry, let's say not earnings before tax. Let's start from earnings before interest and tax of 100,000. And company B also has earnings before interest and tax of 100,000. So the amount of interest expense, let's say interest expense, because let's say company A is funded by loan, so it has borrowed money, and therefore we are going to pay interest on that, while company B has no loan, it's fully funded by equity. So let's say the amount of loan here is $20,000, which means earnings before tax is around $80,000. So in this case, since there is 0 interest, we will say 0 interest. That gives us 100,000 profit before tax or earnings before tax. And then we subtract the tax expense, which is 30% of 80,000. And if we do that, 30% of 80,000, if we do the maths, it is around 24,000. Likewise, if we subtract the tax here, it will be 30% of 100,000, and that's about $30,000 tax, and that gives you net income of 70,000, while the net income here is 56,000. Now, if you notice, both the companies had the same amount of EBIT, but of course, company A has lower net income because of the interest payment. All right, now one thing I want you to notice here, because the company A is paying interest while company B is not paying any interest on the borrowed amount, therefore it reports a lower profit, and a lower profit means that it is paying a lower tax. In other words, interest is tax deductible. So you're allowed to subtract interest from your profits, and then you pay the tax on the leftover profit after interest. So if you notice how much lower tax is company A paying, the company A is saving an amount of around 6,000, around approximately 6,000 tax because of interest payment. So here's how you can look at it. If we look at the cost of borrowing, we are paying 20,000 as interest. But because of this borrowing and because of the payment of interest, we are saving approximately 6,000 tax. That means the real cost of borrowing is actually only 14,000, which means after tax interest, if we take out the tax effect from the interest, it's only 14,000. Another quick way of getting the same answer would be minus 20,000. The 6,000 we could arrive at as 30% of 20,000, which is 30% of 20 is 6,000, and that gives us after tax interest of 14,000. Alternatively, we could also rewrite this as minus 20,000, which is interest before tax, into 1 minus tax rate, and that should give us after tax interest of 14,000. So we are taking out the tax effect. 1 minus 0.3 means if pre-tax value is $1, 1 minus 30% would mean after-tax value would actually be 0.70. All right, having understood this, let's now look at how would we actually do the calculation for a convertible bond. So for basic EPS calculation, we would make the assumption that the bond is not converted. So we assume that convertible bond is not converted. And what do we pay on the bond? We pay interest. Hence, we continue to pay interest. If we continue to pay interest, we continue to deduct it from the profits. And just on a side, I'm going to rewrite this again. We have EBIT, we have interest, we get EBT minus tax, that gives us net income, and then we have minus PD, that gives us EBCS. So that's something you should always have when calculating or when doing this exercise. So here's what we will do for basic EPS. Since it's not converted and we continue to pay interest, if we are given net income, that means interest has already been deducted. So that's fine because we'll continue to pay. Minus, we'll subtract any preferred dividends divided by weighted average common shares. If we are given EBCS, we would just simply divide this by weighted average common shares. All right, how do we find the dilutive EPS to see whether it's dilutive or not? Here's what the exercise we do. We make the assumption that bond is converted. So we assume that convertible bond is converted into common shares. Hence, no more interest. Now, if you're not paying interest anymore, if that's the assumption we're making, of course your profit will go up since you're saving an expense, since you're not paying an expense. And that's exactly what we are actually going to do. So here is how we have always found the earnings per share. We have said if we are given net income, then we subtract always preferred dividend. Now the idea is, look, if we are given net income, which is right here, which means we have already subtracted the interest, but we are not paying interest anymore. So what do you think should we do? If we are not paying interest anymore, we shouldn't be subtracting interest in the first place. But since it's already subtracted and they've given us net income, we will add back interest. Now, does that make sense? Which means if you're not paying interest, your profit will be higher by the amount of interest. But if you have a higher profit by the amount of interest, that means you will pay extra tax. Right? So if you're not paying interest, your profit goes up by the amount of interest, but you'll have to pay extra tax. So we have to take out the tax effect from it, and we have to add back only interest after tax. So we will say interest multiplied by 1 minus tax rate. In other words, our profit goes up, or net income goes up by the amount of after tax interest. So we take out the tax effect from the interest, and that's how it will be, divided by old weighted average common shares plus new common shares. If you are given EBCS, earnings belonging to common shareholders, you don't have to subtract PD, but we will still add the interest because it has already been deducted. So we still have to add the interest after tax. So your profit goes up by the amount of interest, but take out the tax effect. And in the denominator, we have old weighted average common shares plus new common shares. And if the EPS is lower than basic, that means it is actually dilutive. So let us look at this example on convertible bond using what if converted method. So Opnox company reported net income of 750,000 for the year. The company had weighted average number of shares of 690,000. In addition, the company has only one potential dilutive security, $50,000 of 6% convertible bond. Now, this 6% is actually the interest which applies to the par value of 50,000. In other words, we could say interest is 6% of 50,000, and that amounts to around $3,000 of interest. And we are told that each convertible bond is convertible into 10,000 into a total of what we are told is all these bonds are convertible into a total of 10,000 common shares. So all the convertible bonds worth of 50,000 par can be converted into 10,000 common shares. And tax rate is also given to us. And of course, we need the tax rate only for convertible bond, not for convertible preferred shares, because preferred shares have no tax effect. So let us look at basic EPS. And as we discussed just a while ago, for basic EPS calculation, we make the assumption that we continue to pay. So from net income, we continue to subtract preferred dividend. Interest is already subtracted, divided by weighted average common shares. And here are the numbers that we would actually plug in. This will be 750,000 minus the preferred dividend is not given to us, which means there is no preferred stock. So we would assume that this is actually 0. Okay, so divided by weighted average common shares of 690,000. So this would give us the answer of $1.09. That's a basic EPS. Let us look at what if we convert. So what if we convert on paper? What happens to our EPS? Is it dilutive or not? So the assumption is we convert and we do not have the bond anymore, so we don't pay interest anymore. If we are given net income, we will add back interest. So here we are given net income and there is no preferred dividend, so we'll keep that aside. We add back interest, our profit goes up by the amount of interest, but we have to pay extra tax. So let us take out the tax effect from this. So interest after tax divided by old shares plus new common shares. So net income is 750,000. Interest is 3,000. After tax, it will be 1 minus 0.3, which will amount to around net amount of 2,100. You can do the calculation. Divided by old shares are 690,000, while new shares are around 10,000. And with this, what we get is earnings per share is around $1.07. So if you make a comparison, it is actually dilutive, and both basic and dilutive EPS would actually be reported. I would like to make a point again. As I said, since preferred dividends, as you can see here, are actually subtracted from net income and they come below the tax, therefore they have no tax effect. So even when we mentioned here, we did not take into account any tax effect on preferred dividend. We only take into account the tax effect for convertible bond. All right, so now that we have discussed convertible preferred stock and convertible bond, let's now talk about stock options. So stock options and warrants. So stock options are generally granted to employees in order to encourage them and incentivize them so that their interests are actually aligned with that of the organization's interests. So for example, a stock option is actually represents the right of an employee to buy the shares of the employer at a certain predetermined price. So it's the right to buy shares at a certain price called exercise price or strike price, which is also called exercise price. And let's say this right is to buy the shares at $10. So an employee has been awarded a stock option which gives him or her the right to buy shares of the employer at a strike price of $10, let's say after 2 years. So this employee will ensure that during these 2 years, the employee puts in good amount of effort so that the company's performance overall improves. And if the company performs well in these 2 years, the company stock price will go up. And when the company stock price will go up, then the employee can simply exercise this option and buy the share at $10, while in the market, it could actually be worth more. So as an example, if after 2 years, the market price of this share, let's say, is worth $25. Now, if it's worth $25 and the employee has the right to buy the shares at $10, of course, the employee would be happy to exercise it because the employee only has to pay $10. The employee can pay $10 and take the share and sell it in the market for $25. So this is what we have so far understood. Now, how would we know whether stock options are dilutive or not? Now, one simple idea is this. If you notice here, there are two parties. One is the company that has actually issued stock options, and the other is actually the employees. So you have the issuer, or the one that has actually granted the stock options, and you have employees. So how would we know whether these stock options are beneficial or these stock options are dilutive or not? And the idea is simple. If the stock option would benefit the employee, then of course the employer would not benefit from the option. The employer would be at the expense, hence it would be dilutive. So as in this case, when you see that whenever the average market price during the exercise period, because there could be a period, let's say you can exercise after 2 years within 3 months. So we need to look at the average market price during that period as opposed to looking at a single day price. So let's suppose average market price after 2 years is around $25. If this average market price is greater than exercise price, which is the strike price, then of course the employee is going to exercise, and this actually benefits the employee. In other words, the employee is receiving a share worth $25 while paying only $10 if our exercise price is $10. So the employer, which is the issuer, is receiving only $10 for each share that is actually worth $25. Hence, whenever the stock option benefits employee and the employee would exercise it, then it will always be dilutive for the employer, meaning it will bring the EPS down. So in this scenario, it will dilute EPS. So if you're given a question and if you just have to determine whether it's dilutive or not, all you have to do is just simply compare the average market price during the exercise period against the exercise price. And if it's more, that means employees would exercise the options and it would actually be dilutive for the employers. Another way you can think of this could be, let's suppose here is the issuer or the employer. So in normal scenario, an employer issues a share and let's suppose this share is worth $100. So the employer actually, by issuing a share, the employer raises $100 from the issuance of the share. And this $100 is invested. And when it's invested, the employer earns an earnings per share of $5. Meaning, by raising money worth $100 that the employer invests, the employer earns a return of around $5 by making an investment of $100. Now, think of it like this. What if the share price is worth $100, but the exercise price, which is strike price, is $40? And in this case, as we know that the employee would actually exercise the option, that means the company would have to issue a share which is worth $100 to the employee. And in return, the employee only pays $40, which means the company is raising only $40. Now, if these $40 are invested, do you think per share would the company be able to earn the same earnings per share? Of course not. It would actually be lower than $5 because you are investing a lower amount. Previously, the company would raise $100 per share, invest it to earn a return of around $5 per share, and now you're only investing $40 per share to earn a return of course, less than $5 per share. So because of the stock options, certainly you will find that whenever this scenario applies, where average market price during the period is greater than exercise price, the stock options will always be dilutive because the employer receives lower money, and lower investment means lower earnings per share. So having understood the idea, we can now look at the calculation for how to calculate the diluted EPS using a method called treasury stock method. So Hi-Ho Tech Company reported net income of $2.3 million for the year ended 30th June 2018 and had a weighted average 800,000 common shares outstanding. At the beginning of the fiscal year, the company has outstanding 30,000 options with an exercise price of $35. No other potentially dilutive financial instruments are outstanding. Over the fiscal year, the company's market price has averaged $55 per share. Calculate the company's basic and diluted EPS. So for basic EPS calculation, we would assume that the options are not exercised, and if the options are not exercised, therefore the number of shares would not be changed because no common shares would actually have to be issued. And the formula we know is EPS is calculated as net income minus preferred dividends divided by weighted average common shares. So net income in this case is 2.3 million, while we don't have any preferred dividend, and the weighted average common shares are 800,000. Therefore, the answer we get is around $2.88. Now, if we use the treasury method, whereby let's first try and see, are the options dilutive or not? If you notice, the average market price has been $55 per share, while the options can be exercised at $35. That means the employees have the option to buy the shares at $35 while they are worth $55. Therefore, this is dilutive security, and we will have to calculate the diluted EPS using the treasury method. Okay, so the first step is, first of all, so the company has 30,000 options, as you can see here, and we are assuming that each option is worth, each option will give you one share. So whenever you exercise each option, you actually get one share. So the first step is, how many number of common shares do you get if you exercise options? So because there are 30,000 options, as you can see here, that means if the employees exercise 30,000 options, they would get 30,000 common shares or ordinary shares. The second step is to actually find the amount of cash received. So how much did the company get from the issuance of 30,000 shares? So we find amount of cash received from issuance of 30,000 shares. And the answer is, if you notice, these 30,000 shares are being issued at an exercise price of $35. So if we say 30,000 times 35, that means the company actually raised 1,050,000. So it's $1.05 million that has actually been raised from the issuance of 30,000 shares under the options. Okay, so the third step is, If the company uses the same amount of money that it has raised to buy back the shares from the market at the market price of 55, how many shares would it be able to buy back? So using 1.05 million, how many shares can the firm buy back from market? So how much amount do you have? You have 1050000. This is the amount you have, while the market price is 55. So at a price of 55, if you have to buy back each share, if we divide this by 55, the number of shares that could actually be bought back from the market is around 19,091. So these are the number of shares that you can buy back using the same amount of money that has actually been raised under the options. Now here, this should give you somewhat idea actually where are we heading. The idea is that by issuing 30,000 shares, you got 1.05 million, but that 1.05 million is, from the perspective of the market, is only equivalent to 19,091 shares. So we could say it is as if that the company did not get a single dollar for the rest of the shares, which are, so we can find the difference in the shares. So our step 4 is the company actually issued 30,000 shares, while they are equivalent to only 19,091. For the rest of the shares, it is as if the company did not get any single dollar. And because of that, these are the shares that actually cause dilution. So if you find the difference amounts to around 10,909 shares. I repeat again, the amount raised from 30,000 shares, which is 1.05 million, is equivalent to 19,000, is equivalent to issuance of 19,091 shares in the market. So for the rest of the shares, it is as if that the firm did not get a single dollar, hence they will cause dilution. So these will cause dilution. And what is the last step then? How do we find the basic EPS? Well, here's what we do. How do we find the dilutive EPS? We would say net income minus your preferred dividend divided by weighted average common shares, whatever are the old weighted average common shares, plus dilutive shares. So you're just adding, and the dilutive shares are 10,909. So all you're doing is you're just adding dilutive shares to the denominator, and here's what it will be. It will be 2.3 million minus 0 divided by the number of shares were 800,000 plus 10,909, and the answer is 2.84. As you can see here, before it was 2.88, and now the earnings per share has actually dropped down to 2.84. So the reason why this method is called treasury method is because we make the assumption that we are actually buying back, and this is the term used by the US GAAP, while IFRS does not use any term like this. It doesn't assign any name or label to the method, but the steps and the result would actually be the same under IFRS as well. So as a quick summary, you first find the number of shares that would actually be issued under the option, which was 30,000 shares. Each option is 1 share. Then you would find how much money does the company raise from the issuance of these 30,000 shares under the options. At an exercise price, it's 1.05. So to use the same money to buy back shares from the market, how many shares would the company be able to buy back? And that's around 19,091. In other words, what we are saying is the 30,000 issued shares are only equivalent to 19,091 in terms of the amount. Hence, the remaining shares actually cause dilution, which you simply add to the denominator right here, and that gives you the diluted EPS.